Today, we will take a closer look at Meta, the global leader in social media, owning the family of apps ecosystem, which includes Facebook, Instagram, WhatsApp, Messenger, and Threads, with the largest user base in the industry. After experiencing a decline in profitability in Q3 due to cost pressures and heavy investments in AI, Meta's Q4 fiscal year 2025 results showed a clear rebound. Revenue reached $59.9 billion, representing a 24% year-over-year increase, driven primarily by strong growth in advertising across its core platforms. Gross profit amounted to $49 billion, translating to a gross margin of 82%, while operating income reached $24.7 billion, largely driven by the family of apps, as Reality Labs continued to post losses amid ongoing long-term investments. After taxes and other expenses, net income came in at $22.8 billion, and EPS reached $8.88, exceeding market expectations. When looking at the revenue structure, it is clear that Meta's revenue over the past several years has been heavily concentrated in advertising, accounting for approximately 97% of total revenue. Advertising revenue increased from around $27 billion per quarter in 2022 to $58.1 billion in Q4 FY25, implying a CAGR of approximately 22.9%. This high level of dependence has prompted Meta to gradually roll out paid subscription models on Facebook and Instagram, while expanding and accelerating monetization initiatives beyond advertising in order to diversify its revenue base. On the other hand, payments in AMP, which is closely linked to WhatsApp Business, click-to-WhatsApp ads, and messaging and payment services for businesses, has recorded a very high CAGR of approximately 62.3%, but currently contributes just over 1% of total revenue. Meanwhile, Reality Labs, focused on VR/AR and the metaverse, has a CAGR of around 9.5%, with revenue remaining relatively small and operating losses amounting to several billion dollars annually, indicating that this segment remains a long-term strategic investment rather than a near-term revenue growth driver. Alongside revenue growth, Meta's user base has continued to expand steadily across its entire ecosystem. Daily active people increased from approximately 2.1 billion in 2019 to nearly 3.6 billion by the end of 2025, highlighting the enduring appeal and scale of Meta's core platforms. Notably, in July 2023, the launch of Threads, positioned as a direct competitor to X, formerly Twitter, quickly surpassed 100 million users within a short period, further strengthening Meta's ecosystem and reinforcing its leadership in social media. At the same time, ARPP, average revenue per person, more than doubled, rising from around $7 to $8 to $16.60, reflecting improving advertising efficiency and stronger monetization per user. With Meta expected to roll out paid subscription offerings, ARPP is projected to continue its strong upward trajectory in the near term. Next, we take a broader look at the global social media advertising market and Meta's position within this landscape. In terms of user scale, Meta's platforms continue to lead the market, with Facebook exceeding 3.07 billion monthly active users, while Instagram and WhatsApp are each approaching 3 billion users, far surpassing most other social media platforms. This overwhelming user scale, combined with rich behavioral data and a well-established advertising ecosystem, enables Meta to maintain a dominant position in advertising revenue. According to 2026 forecasts, Meta is expected to capture approximately 49% of global social media advertising spend, equivalent to over $134 billion, significantly outpacing its competitors. Meanwhile, the global social media advertising market is projected to expand from $228 billion in 2024 to approximately $401 billion by 2029, representing a CAGR of around 12%. Given its current position, Meta is expected to remain the primary beneficiary of the long-term growth in the global digital advertising market. Looking at revenue by geography, the US and Canada remain Meta's largest market, generating $26.5 billion in Q4 FY25, accounting for approximately 44% of total revenue. Growth in this region is primarily driven by high ARPU and improved advertising efficiency enabled by AI, despite a relatively mature user base. Europe contributed $14.5 billion, or around 24% of revenue, maintaining steady growth of approximately 14.6%, although it continues to face regulatory constraints around data and privacy. Meanwhile, Asia-Pacific generated $7.8 billion, representing 13% of revenue, reflecting a region with a large user base but lower ARPU. Notably, Rest of World delivered $11.2 billion and recorded the highest growth rate with a 36.8% CAGR, driven by rapid smartphone adoption, high engagement on Instagram and WhatsApp, and increasing advertising spend from small and medium-sized businesses in emerging markets. AI is clearly emerging as Meta's core growth driver for the 2025 to 2026 period. The first and most immediate impact remains in advertising, where AI is enabling growth through efficiency rather than higher ad load. Specifically, ad impressions increased 18% year-over-year, while the average price per ad rose by 6%, driven by AI-optimized delivery and targeting. Real-time AI models further improve conversion rates by 3%. And importantly, AI-driven ad redistribution generated roughly 4 times the revenue impact compared with traditional ad load increases. Building on this foundation, Meta is expanding into creative AI and advanced measurement solutions. AI-powered video creation tools reached an estimated $10 billion revenue run rate by Q4 2025, growing at 3 times the pace of overall advertising revenue. In parallel, new attribution models delivered 24% incremental conversions, rapidly forming a meaningful new revenue stream within a short period of deployment. AI is also accelerating business messaging, particularly on WhatsApp, into a new growth pillar. Click-to-message ads in the US grew more than 50% year-over-year, while paid messaging on WhatsApp surpassed a $2 billion annual run rate. As a result, Family of Apps Other revenue increased 54% year-over-year, reaching $801 million in Q4 2025. On the engagement side, Instagram Reels watch time increased 30% year-over-year in the US, while Threads continues to gain usage momentum and is scheduled for global ad rollout in 2026, expanding future advertising inventory. Meanwhile, Reality Labs remains a long-term investment. Although the segment continues to post losses, smart glasses sales more than tripled year-over-year, and 2026 is expected to mark peak losses before a gradual decline. To support this strategy, Meta plans $115 to $135 billion in capital expenditures in 2026, focused on AI data centers, training and inference compute, custom silicon, and energy infrastructure. Despite the scale of investment, Meta expects operating income to continue growing in absolute terms, underscoring the company's confidence in AI-driven monetization. Operating income provides the clearest picture of Meta's performance in recent years, as Family of Apps continues to serve both as the company's primary growth engine and as the financial buffer absorbing losses from Reality Labs. Specifically, Family of Apps operating income increased significantly from approximately $13 billion in early 2021 to $30.8 billion in Q4 2025, alongside a recovery in operating margins to above 50%, highlighting improving operating leverage and profitability. Meanwhile, Reality Labs remains in a long-term investment phase, with operating losses increasing over time, reflecting Meta's long-term strategic investment in the metaverse, VR/AR platforms, and wearable devices. Looking at the operating expense structure, it is clear that Meta is placing a strong priority on research and development spending. Research and development expenses have grown at an average annual rate of approximately 24.6%, increasing from just over $5 billion in early 2021 to $17.1 billion in the fourth quarter of 2025. Notably, research and development spending accelerated sharply in the third and fourth quarters of 2025, in line with Meta's plan to invest around $70 billion in capital expenditures during 2025, focused on building artificial intelligence infrastructure, including data centers, computing capacity, and internally designed chips. Meanwhile, general and administrative expenses have grown at a slower pace, at around 2.9% annually, reflecting continued cost discipline even as the company increases investment in artificial intelligence. In contrast, sales and marketing expenses have declined, falling at an average rate of approximately 6.2% per year, indicating that Meta is increasingly driving growth through its platforms, data, and algorithms, rather than heavy marketing spend. Next, looking at net income growth and net margin. Meta has clearly rebounded following the downturn in 2022. Net income increased sharply, rising from a trough of $4.4 billion in the third quarter of 2022 to $22.8 billion in Q4 2025, demonstrating a significant improvement in Meta's earnings power. Net margin also expanded from a low of approximately 14 to 16% in 2022 to around 38% in Q4 2025, reflecting stronger cost discipline and improved operating leverage. Notably, in Q3 2025, net margin declined sharply, primarily due to a one-time tax charge of nearly $15.9 billion resulting from changes in U.S. tax law, which temporarily weighed on net income. However, this impact was non-recurring, and profitability rebounded quickly in Q4 2025. From fiscal year 2022 through fiscal year 2025, Meta's reported revenue has generally tracked closely with market estimates, indicating a high degree of stability and forecast visibility in the company's core business model. Looking ahead to fiscal year 2026, consensus estimates project Meta's revenue to reach approximately $230 to $240 billion, representing growth of around 18% year-over-year, supported by AI-driven improvements in advertising performance and initial contributions from paid subscription offerings on Facebook and Instagram. In contrast to revenue, earnings per share, EPS, have exhibited greater volatility relative to expectations, primarily due to one-off costs and rising investment in artificial intelligence. Based on current consensus, EPS for fiscal year 2026 is projected to be around $30 to $32, with a relatively wide range reflecting sensitivity to cost and tax assumptions. Nevertheless, as revenue continues to grow while costs remain comparatively controlled, incremental revenue is expected to flow more directly into profit, allowing EPS to grow at a faster pace than revenue over the medium term. Investor sentiment toward Meta's stock remains constructive, as shares rebounded quickly following the release of better-than-expected fourth quarter 2025 results. This rebound came after a meaningful pullback earlier, which was largely driven by short-term concerns around elevated artificial intelligence investment and higher capital spending, rather than any deterioration in Meta's core business fundamentals. According to consensus from 61 analysts, Meta's average 12-month price target stands at approximately $857, implying over 21% upside from current levels. In the bull case, the highest price target reaches around $1,144, reflecting strong expectations for AI-driven earnings growth, improving advertising efficiency, and incremental contributions from paid subscription offerings. In contrast, the bear case places the price target near $700, suggesting relatively limited downside risk based on current market assessments. In terms of analyst ratings, sentiment remains strongly positive. Based on ratings from 73 analysts over the past 3 months, Meta is currently rated strong buy, with 57 strong buy recommendations, 11 buy ratings, 5 hold ratings, and no sell recommendations, indicating broad institutional confidence in Meta's long-term earnings outlook and strategic execution, despite recent share price volatility. Thank you for watching. The information presented in this video reflects opinions at the time of publication, is based on sources believed to be reliable, and is provided for informational purposes only. It does not constitute investment advice or a recommendation.